Hello, everyone. Welcome to Beers with VCs, where we have casual conversations about the less talked about aspects of venture capital and startup building. We are your hosts, Sabrina Passman and Simon Lancaster, and today we are honored to be joined by Sebastian Mallaby. Sebastian is one of the leading writers on finance and innovation. His book, More Money Than God, is considered the definitive history of hedge funds, and The Man Who Knew. His biography of Alan Greenspan won the Financial Times McKinsey Business Book of the Year. And most recently, he wrote The Power Law, which is regarded as the most comprehensive history of venture capital. We are so excited to have him on. Sebastian, welcome to the podcast.
Great to be with you, Sabrina and Simon.
Yeah. Before we dive in, we'd love to just do our usual round of what we're drinking today and do a little bit of a cheers. I have got lead us off, a hazy IPA. Got my fancy glass as well. So very excited to dive right in.
Which one is that, Sabrina?
It's called Athletic Brewing Company.
Oh,
yes.
Very cool.
Very exciting.
Nice.
I want to point out, Sabrina, that you're in the West Coast and you appear to be American.
Simon's going to one-up me too.
I'm British. I'm from Britain. I'm speaking from Britain. And what I have here is, plain dihydrogen oxide. You're not playing to type.
The fanciest of beverages.
And the true athletic drink of all times. I'm sticking true to the theme, and my favorite Mexican beer for today, Modelo Negra. Not the Especial, but this one. It's very good. And always try to get it whenever I go to Mexico or locally here in California.
Oh, nice. I love it. Well, cheers, everyone. Excited to be here today.
Cheers. Sebastian, we still haven't met in person, but hopefully September when I'm in London. Really looking forward to
get real beers.
A real beer or whatever the beverage is, tea time. but I do have to say I'm very excited for today's episode. It's been a long time coming that I've been thinking of having you. I think this is probably we're in the teens now in the episodes. And when we first spoke shortly after Power Law was released, I was really blown away by the comprehensiveness and how much it enthralled me. So yeah, really, really excited to chat, and with our upcoming book as well. Happy and excited to start changing notes and chatting together about VC.
Mm-hmm. Absolutely, Sebastian. I think so. For the audience, I would love to just start by maybe you sharing a little bit about your background and how you started writing all of these incredible histories of the finance world.
Sure. So I left college and joined The Economist magazine in London. And I did a whole bunch of different things there. I was the Africa correspondent. I lived in Southern Africa and Zimbabwe, traveled all over Africa. When Mandela got out of jail, I was outside the jail waiting for him to come out. And so I figured that at that point, my career would be downhill thereafter, because nothing could be as exciting as watching Mandela come out of jail. And then I did a few other things at The Economist, wrote about finance and economics, went to Japan, wrote about finance in Japan and business in Japan, came to Washington, D.C., was the bureau chief for a bit for The Economist, switched to the Washington Post, where I wrote a kind of wide-ranging political economy weekly newspaper column, as well as doing the unsigned editorials back when that was a thing in journalism. And then along the way, I'd done a couple of books, and I decided that was where I wanted to really focus more of my effort. I moved to the Council on Foreign Relations, which is a fantastic think tank based in New York and Washington, D.C., which is a terrific home to think and write books. And I've done a string of books there. So I think you mentioned the last three about hedge funds, about central banking, about venture capital. And that venture capital book was a bit of a segue between finance and tech. And so I can reveal here, exclusively, that the next book is sort of more pure tech. It's a book about artificial intelligence.
Wow.
Oh, we are so excited and honored to have that bit of information and something to look forward to for a new release.
Sebastian, I remember you mentioning that you had done, and it's evident in the book as well, years of research for Power Law. how was it to transition to a new field, like a more technical area, and then also was it similarly as intense or more intense?
Each book is wonderful and challenging in its own way. I mean, clearly with artificial intelligence, it's a whole new set of things to get my head around. I've tried to grapple with, sort of conceptually at least, how the models work. I think I've gone further in that direction than the other books, the other sort of non-technical books that have come out so far. So I'm trying to bridge that area between the technical experts and the layman. So the idea is that any sort of interested reader of The Economist or the New York Times could pick up this book and understand it, but it would go deeper than the other stuff that they've understood. So I've learned about the ongoing fight between reinforcement learning and deep learning, the kind of symbiotic relationship that they have, which I think is one neat way of understanding the history of AI in the last 10 years. A whole different range of things to when I was doing the power law, and it was more about how do you think about the generation of value in an investment class where quantitative metrics simply really don't apply, right? I mean, Series A or earlier, you've got no, book value of a company because there's no assets, no price earnings ratio because there's no earnings. You've just got two people who walk into your office with a dream, and you have to evaluate that.
I loved how you wrote The Power Law. It reads more like a drama than like a history book. And I'm curious, what was the research like, and how did you compile and build these stories in that fashion?
Well, I mean, in the kind of exploratory phase, I always just go out and talk to people who know something, or might even just know somebody who knows something. And it's really, you're fishing around, reading what you can read, but also just having long conversations with anybody who's willing to do that. And so I had a bit of a springboard because my previous books had created, some reputation, particularly the hedge fund book. That was another asset class. And so there were, famous hedge fund people who knew famous venture capital people. And so the first trip I went out, I remember I had meetings with some pretty distinguished people in the Valley. And it still took me, probably 2 or 3 trips before I was starting to understand anything about how the real thought process worked. I found that there's a lot of anecdote in the Valley. You ask somebody, so why did you accept money from this VC, not that VC? Or you ask the VC, what did you see in this startup? What really was compelling? And you'd get these cute stories like, I remember Patrick Collison of Stripe talking to me about how when he'd been to see Mike Moritz at Sequoia, the two had bonded over cycling because Mike walked Patrick out of the Sequoia office and they were standing on the threshold together, and there was this bike that was tied up against the railings. And Moritz said, "Oh, I don't recognize that bike. Is that your bike?" And they started talking about who had the faster time on certain iconic climbs in the valley. And both of them sort of said to me, "Yeah, so we just hit it off, and so we did the investment." And I'm like, "No, surely, come on. This is a serious asset class. It's not about cycling." and so you have to sort of get to the stories underneath the stories before. And it initially just seems completely random and serendipitous. And I think the fun of it was penetrating a bit deeper. But I mean, to answer your question directly, there's never, I always start with the idea that there's going to be a chronology because I think readers understand it better if there's a chronology. And there's a double trick there. One is that people like stories that develop over time. And the other is that the explanatory side of my books starts with early in the story. The asset class is very simple, or the technology, let's say AI, very simple. And it's pretty simple to explain it. But then as you go through time, it becomes more sophisticated and complicated, but you can layer on additional explanation for the reader as you go through the time sequence. And they kind of absorb it in a comfortable way. If you just hit them with, dense explanation from page 1 to page 300, you wouldn't have very many readers. But if you blend it into the story, people can attain understanding in a much more fun way.
Makes total sense. Versus just having a massive glossary of acronyms at the back of the book and making people flip back and forth.
Yeah, I mean, my premise is that pure storytelling is sort of cute, but ultimately pointless. And pure explanation is full of point, but nobody will get the point. And so you need to kind of blend the two.
I was really enthralled by the way that you painted the whole history, because I realized that there certainly have been cycles within the venture capital ecosystem, and they seemed, on the broad scale, times of hypes and times of crashes, but it actually seems cyclical. And I'm wondering if you can maybe outline the overall picture of like the 4 stages of the cycles that typically happen inside of the venture ecosystem so far.
Yeah, I mean, I chose to begin my story in the late 50s with the financing of Fairchild Semiconductor, and then through the 60s when Arthur Rock, who was the first, what I regard as the first kind of real venture capitalist, had his fund that did incredibly well. I think it returned more than 30x, and that's really that was the origin story that then made it go contagious because people wanted to copy him. So there was this bull market that was going on at the time, both in public valuations and in private ones, because the economy was pretty good. And then in the early 70s, you have this blowout, and the public market crashed, and venture capital valuations crashed, and indeed, fundraising for venture capital crashed. And famously, at the end of the 70s, there was a Business Week cover story called The Death of Equities. So you went through this terrible bull market, and in that period, it was very, very hard to have any kind of exit or to raise money. And then starting in the early 80s, partly with the IPO of Apple in 1980, Genentech, I think was the same year, you have a sort of upcycle, late 70s, early 80s. This really was the hot period. And then things kind of crash again with the 1987 stock market crash, but not for long. That turns out to be a bit of a blip, both, by the way, in the public and in the private markets. And then you get into the roaring 90s, the internet boom and so forth, and everything's great until famously in 2000, the NASDAQ crashes, and you've got this winter for venture capital in the early 2000s. But I think, yes, there are different series, different sort of phases in these cycles. And I think, Sabrina, you've thought quite specifically about what this means, and maybe I'd love to hear you articulate that. But I would say that one of the interesting things is that some of the good companies get built in the down cycle. But anyway, you tell us what do you think?
I completely agree with that. I mean, what's interesting in the way that you painted the book too is that there are different strategies to be taken during different parts of the cycle that have historically yielded in success. And I'd say that there have been a couple of different crashes throughout. And then after the crashes, as you're pointing out, the best companies that are able to survive those crashes really do outperform typically. And from there, that flocks money back into the ecosystem. Then valuations get overhyped, and there's a very big ballooning event. And then eventually that bubble pops and everything kind of goes back down again. And I think that history is so important for venture capitalists to understand, especially to realize where we are inside of that cycle. I think maybe before we dive into where we are today within the cycle, I would love to get your feedback on what piece of that cycle was most exciting for you to research and learn stories about.
In a way, I think it's when there's a crash and people are super pessimistic, and you're in the sort of money is not plentiful phase. That's when it takes guts to make an investment, but B, you may be, as an investor, doing the best because you've got not too much money chasing the deals. You've therefore got better valuations from an investor standpoint. And, it's easier for the startup that you're backing to hire talent because there's less competition to hire the talent.
Mm-hmm.
And I mean, there are famous stories about this. So Sequoia's investment in Cisco in 1987 was pretty much the best deal it did in the 80s. And, they rode that one right into the 90s because the founder of Sequoia, Don Valentine, stayed on the Cisco board even after it went public. And that gave him kind of amazing intel about what was going on in the whole internet build out, the hardware, plumbing. So that really was an iconic investment for Sequoia. And yet they were advised not to do it at the time because the stock market had just crashed. But they did it anyway. And then, of course, there are famous stories about the companies that got built or that got started after the NASDAQ crash in 2000.
Particularly with Sequoia at the forefront, there are so many pieces throughout the story about how they seemed to preempt the next waves and how they leveraged existing knowledge of, I guess, not just insights of their present investments, but like ideas throughout the macroeconomy around where the industry seemed to be headed. And they seem to have a sixth sense about that. Did you notice any commonalities into how they were able to do that consistently? Was it just being extremely analytical? How did they, and others, I guess, that you've interviewed, figure out, I guess, the prediction of the future? Like, was there any secret that you realized after interviewing all of these folks?
I think what Sequoia did is less to predict cycles than to be extremely tough when you have a downturn. So they had this famous slide deck that was called RIP, the Good Times. I actually think that was 2008, not the 2000 downturn. But, I think because they'd been through 2000, they spotted 2008 straight away. And the point here is that, if you sometimes markets tend to go up gradually over many years, right? Bull markets are sort of slower and relatively gradual. But then down markets in finance are often very, very sharp and they reset the environment very brutally. And so if you're a founder, you've got to quickly adjust your mindset to understanding that the next round of raising money is going to be super difficult. You're going to have customers who cancel their contracts because they're in hard times. And, any plan that you had before the crash now has to be rethought. And that's where we were in sort of after these big dislocations, like, the NASDAQ comes down by 30% or whatever it was in 2000, or the 2008 blowout in the public markets. And so I think what Sequoia did is that, they had experience of this. So they went to see their founders who are builders, who maybe haven't lived through other cycles like this before, and just got that message through. Listen, if you want to survive, you've got to immediately start preserving cash and immediately start, thinking about how you're going to make it through without getting fresh money in the door for the next, 2-3 years.
Yeah.
Or did they offer them a bunch of money at that point in time and double down?
I think they probably would have wanted to. That's a good question, because I think that is the other part of the playbook. But you're not going to throw money at people unless they take the pain themselves first. They've got to show willingness to rethink the plan, and then you support them and help them to get through. Because I think if it's a great discussion, this cycles thing. But if you stand back and you think about venture, it's actually less cyclical than investing in a hedge fund or in public markets, right? Because their interest rates are super important, and you can't escape the market cycles. Whereas any venture investment is basically a 5 to 7 year bet, right, till exit. I mean, there are some which might be shorter, but not many. And so, in some sense, the cycle, it can hit you as you're building, and the founder needs to recalibrate for sure. But from the investor standpoint, if you believe in the company, a downturn, a financial downturn shouldn't really change that. It's more about the technology. And a good illustration about the way that venture is not too dependent on cycles would be to say, look, okay, think about 1994. in 1994, interest rates were raised very sharply by the Federal Reserve. There was therefore a collapse in bond valuations. All kinds of hedge funds, like Michael Steinhardt's famous one, collapsed, lost tons of money. There was a bank that almost went out of business. It was basically a bloodbath in the financial markets in Wall Street. But in venture space, what was going on in 1994? Netscape, right? I mean, the birth of the iconic internet companies, the invention of the browser, et cetera, et cetera. So the point here is that the technology wave trumps the financial cycle, I think. And so, you see that a bit now. I mean, Sabrina, you said you wanted to come onto this, what's going on right now. I mean, I would make a big distinction. We have one financial climate for all venture capital bets today, and yet we see two split screen sort of parallel venture capital worlds, because there's the AI world where money is very loose, and the rest of the sector where it's pretty tight, because the technology dominates the financial cycle.
Absolutely. I completely agree with your point about the technology trumping the financial cycle to an extent. And I'm curious, in terms of the bifurcation of the industry that you're seeing right now, have there been previous bifurcations around technical waves in previous downturns as well? I think the technological cycles, if we look back, have been technologies surrounding the transistor. Then there was the internet wave, and then there's the mobile wave, and now there's the AI wave. And thinking through previous downturns, I guess we can say that there was Facebook in those early downturns, and then after .com, LinkedIn and YouTube. So LinkedIn and YouTube certainly, I guess, were on the side of the internet and social network, social media wave, and Facebook similarly. But outside of those examples, was capital loose in the rest of the industry as well? Or do you think that they were chasing these, you think the rhetoric was to chase the technological wave at the time?
I think it was about chasing technological waves, but I think also that, memory plays tricks on us, and we tend to forget the technological waves that appeared to be promising and then actually fizzled out. So a couple come to mind immediately. One is that following, I mentioned in 1980, there were these two iconic IPOs. There was Apple and there was Genentech. And Apple seemed to signal the arrival of the PC, and therefore there was going to be a huge build out of PC peripherals, mouse technology, networking technology, Ethernet, all that stuff. And that indeed was the wave of the 1980s. Huge amounts of money went in and lots of money was made, and hence Cisco was a sort of, epochal investment for Sequoia. But the other thing, Genentech seemed to herald a biotechnology wave, because Genentech, I think, had been founded in like 76, something like that, and it had gone public in 80, fantastic exit. And everyone thought, wow, and in fact, Sequoia had a whole healthcare practice in the 80s, but it closed it down because actually it turned out that because of the time it took to do clinical trials, and just the difficulties of actually putting molecules in human beings, it was super difficult to get an exit that made your IRR look good, because it just took too long, too difficult, too capital intensive. And so we forget that. But actually, that was a technological wave which many people thought was going to work and didn't. And similarly, if you think about, the period when Facebook was being built, and LinkedIn and those other ones that you mentioned, kind of Web 2.0, in the period after the 2000 crash, yes, those things all worked and we remember them. What we forget is that there was a parallel green technology investment wave, which completely failed, which pretty much, sank Kleiner Perkins, right? They went from being the top venture partnership in the world, circa 2000, to being not even in the top 10 in 2008, 2009. And that was mainly because of going way too deeply into clean tech on the theory that, hey, the government's going to price carbon. Well, it didn't. And so that proved to be a big mistake.
Interesting. So it seems like the industries that require external policies that couldn't just be carried on the back of the consumer, those are the ones that were not the darlings of the venture cycle.
Yeah, I think that's a great point. I think in both cases in those stories, you see a misjudgment of the regulatory climate and the policy climate. So I agree with what you're saying. I think probably if we thought hard, we might be able to come up with things where people just misjudged the technology, although often that turns out to be not being wrong, but being early. Now, being early can be the same as being wrong, but I mean, I tell a story in The Power Law about a sort of early attempt to build a tablet computer in the early 90s. And this was a Kleiner-Perkins, fiasco, hilariously disastrous. But, again, tablet computing obviously was a thing. It became a thing with the iPad and so forth. It's just that it was way too early to try and build it then. So perhaps our memories erase those sorts of things. But I do recall writing my book and kind of finding statements from various luminaries saying, the big 4 technologies of the coming 10 years are the following. And there would be like 1 or 2 where they were right, and then 1 or 2 where we just totally forgot about that thing because it just didn't work.
I would like to circle back to where we are in the present macro. We are kind of in a recovery event right now. And yes, there's a wave of innovation around AI, and then there's a wave of innovation around everything else. And I would like to understand, given the bifurcation, what that implies for the successes that we're seeing in the venture industry. I think that, while I appreciate that the technology innovation waves trump the macro, it's going to be very clear that certain VCs in the next, 5-10 years profit off of have strategies that profit off of the AI wave versus ones that profit off of the everything else wave. And I'm curious if you have any predictions around what those strategies would look like and how those should be playing out right now.
Yeah. One of the things which I think is super interesting about venture, which I write about in my book, is this idea of the prepared mind, which was invented by Accel when it was founded in 1983, and then spread from Accel as Accel investors moved to Benchmark, moved to Sequoia, and so forth. And essentially, the insight here is when you do a kind of company offsite, or sort of you step back and you think deeply about where you think technology is going, you're going to make some predictions about which kind of technology is ripe for being commercial, something valuable in the next 3 years or something. But along with that judgment, you also need to make a kind of business judgment about, okay, but what will the business model be around that technology? What type of founder will be associated with that technology? And I think what we're seeing now, particularly the AI space, which I spent some time on, is that it's a super complicated, interesting moment where, if you think about, okay, if you think AI is obviously a huge deal, there's going to be applications built on top of these foundation models, which will capture a lot of value because they'll create some specific application that consumers like, and you'll get stickiness with those consumers. And by the way, you can probably switch the foundation model that you have powering your application, you can switch that out. And since there's multiple foundation layer builders, maybe the economics are going to accrue to the application builder, not the foundation layer. So there's a sort of this I think commonly shared venture capital mindset right now, which is if we're going to invest in AI, we're going to do these applications. They're less capital intensive than trying to build another foundation model, and they may actually be a better business. Okay, but then you start doing these businesses, and you realize that if you're building this kind of AI application business, it's just not like any previous business, right? For example, what is a product manager? Product manager is somebody who tries to figure out what consumers might want and then liaises with the engineering team to build that thing. It has a sort of roadmap for how you're going to sequence these improvements in the product. But with AI, the foundation model is changing so fast that you can't have a sort of abstract theory about, oh, the customer wants this, so we'll build that. It's like more, we have to wait and see what the foundation people are going to generate, and then we kind of have to pivot off that because it's changing every 3 months. And so I think we're in a moment, and this is where I'm a bit worried about the amount of money that's going into venture capital for AI. It's because, it could be an A+ technology and a C- business model, and indeed not a discoverable, not a knowable business model. But I'd be interested in you guys. I mean, what do you think? And maybe you can broaden the discussion out beyond the AI into the non-AI half of the split screen.
I think what you're mentioning just now around the direction of capital towards AI and certain technologies, I think it's interesting that every technological advancement has a saturation point. And a lot of VCs tend to blow completely past the saturation point and lose out on all of the upside of the alpha that the industry inherently carries. And what we have seen from our perspective, surviving the crash of 2023 and now pulling up on, I think the pendulum is swinging back towards a little bit more of free-flowing capital, once again, especially with the Figma IPO that just happened recently. There needs to be some discipline around identifying true niches that exist inside of the industry without oversaturating them from a capital standpoint. And one of our theses, inspired by looking at the histories that you've painted in your book, Sebastian, are realizing that there is a huge opportunity right now for what we classify as the niche VC, which we paint as a multiplication of mastery, focus, and network. And those three pieces are things that we believe will outperform in the industry as we're moving forward. When we talk about the opportunities that exist right now outside of the AI world, there are plenty. And I think that as we're looking back through history, there is a huge shift towards the technologies that rode the technological waves. But there are many ways for, I think, each wave to completely shift different verticals within the industry. So if we take a look at other technological waves around fintech, around Salesforce, there are so many digitization plays that have played out inside of various aspects of the industry so far. And I think that AI is going to unlock the remainder of digitization of those plays.
Of other industries.
Mm-hmm. Exactly.
Yeah, so you can see the spread of that digitization being extended by AI.
Exactly. And I think that's where that's currently undersaturated. The things that are oversaturated right now are, the foundation model. The foundation model is applied to the physical world in the name of humanoid robotics. Those things seem like, actually, we have a framework inside of our fund that describes the consensus versus the upside potential and outsized alpha. So if we take a look at the chart, we view that humanoid has an incredible amount of consensus, but so far the revenue generation possibilities in the past couple of years are certainly not there yet. Perhaps in 10, 15 years, once the policies catch up to allowing humanoid in the consumer environment, that's something that we'll be able to outperform. But in the short term, it's something that is going to be very challenging to see returns. And I think to our previous point around certain policies limit the explosive nature of some promising technologies. We need to be careful as venture allocators to not get swept up inside of the hype of the possibility without the guardrails of the policies that actually exist in place right now.
Yeah, I mean, I think, one sort of less sophisticated way of trying to make the same point would just be to like stick to what you know. If you can find opportunities that really play to your expertise, then I do think you've got history behind you, because one clear pattern in the 40 or 50 years that I cover in my book is that VCs become more specialized. You start up with, a really immature business. So, one VC might just do deals in anything that comes along, to then more switching to prepared mind and sort of thinking ahead, okay, what technology waves do I see coming and what do I want to do? What do I not want to do? And then more and more specialization as things go on. And that's just part of the progress of any maturing financial specialty, is that people specialize more, become more expert at it, and to compete, you need to know more. This is, classic division and specialization of labor that Adam Smith talked about. Something that's going on in venture as well. And that can lead to something as a bit of a, segue from what we were talking about before, but it can lead to, this belief in solo VCs. But I think for a different set of reasons, it's better to be a team than an
I would
individual.
love to, yeah. Can we elaborate on your stance around the solo GP, and from your view of history, what has actually worked in that realm?
Well, one of the things I was not expecting to discover at all, but I came to appreciate deeply as I was doing my research, was that, venture really is a team sport. And the reason it's a team sport is partly that, if you've got more than one GP, you can pool your knowledge, pool your network, and just give better advice to the founder. But it's also, in a more subtle way, that because venture is an investment class that has no objective quantitative metrics, all you're going on is judgment. And to have good judgment, I believe it helps to be talking to a trusted partner, another GP who will challenge you and who will, you'll be friends, but you'll also be challenging each other. And then thirdly, I think it just stands to reason that, this is a long game, right? You invest you set up a fund, it's going to run for 7 years or something. You hope that you build brand equity in your venture partnership, and you're doing fund 3, fund 4, fund 5. This is a long game. And to reap the benefits of that long game, betting on one individual and that person's energy and health and life, accommodating an unbroken 100%, 120% focus without interruption for like 30 years. I mean, who are we kidding? That's just not how we are as human beings, right? We have moments in our lives when we're not going to be as intense. And so I think a team is better than an individual for all these reasons. And I think you can even take it a step further and start thinking about, okay, you've got a team, you're discussing an investment thesis. How do you optimize the quality of the discussion between the team members to really come up with a good judgment? And that's where, Sequoia deployed behavioral science to shape the way they had their partners meetings, which is something else I get into in the Power Law.
Yeah, I'll just add a comment there. So I completely agree that venture is a multiplayer game, especially early stage venture. I think maybe mega VC, multi-stage firms maybe trying to play a different game. But I think what we've noticed is that the best deals that we've done up until Series A have been collaborative deals where we tried to maximize the value on the cap table with complementary VCs. And yeah, I think by extension, your point about collaboration, thoughtful, provocative, and maybe even professionally argumentative conversation internally is really, really important. So Sabrina and I do that every day. We butt heads every day. We're very, very different. I'm very liberal and divergent thinking. Sabrina is very conservative and cautiously optimistic. Once I
bring out the optimism in me, honestly, I'm relatively pessimistic. If
I didn't want to stay pessimistic. And then you never know, right? When you need to take a day or two off. I just cannot imagine this role being a solo GP. That being said, I think the counter argument I've heard sometimes is speed of decision making and the benefits of solo GP. But given the right team structure and the right optionality and the right ability to, execute as needed, I think the right team certainly is probably stronger than the solo. Yeah. In this job, it's like 24/7.
Speed is important in competitive bidding situations. I do get that. But at the same time, it's kind of nutty, right, to me to say, okay, we're going to do this investment. We're effectively going to be married to this founder for like 5 to 7 years. But we need to make this decision like now, and we can't have a partners meeting about it. I mean, delay it by like 3 or 4 days. I don't know. I mean, if it was one of my kids thinking about their wedding, I would cancel. But 3 or 4 days of discussion before you make the commitment, not a bad idea.
Yeah, I think you bring up a good point. Circling back to the specialization topic, I was on a podcast yesterday, and an audience member asked me, "How do you deal with FOMO in venture?" And I said, "We just try to stay away from it." Like to Sabrina's earlier point, we're trying to stay away from the froth. We're trying to look into niches, into areas that are kind of ahead of the curve, not yet consensus driven. And I think you bring a good point. And this is where value besides money starts to help, right? I believe if you're actually bringing a specialized network, access to customers, access to other complementary VCs to round out the cap table, then founders will wait. They'll make room on the cap table, or they'll hold off the other VC. And we've seen this time and time again.
I would say that although I'm not persuaded that a solo GP is a good idea, I do think that being small can be a good idea. Right? I mean, and I think you sort of alluded to this. You said there are the big funds, and they may be playing a different
game. We're calling
them
mega funds. I'm just kidding.
Yeah. I mean, I think you were being sort of tactful, but I mean, to be less tactful, I would say that, there's just this inexorable logic that if you're running a very, very big fund and you're doing all kinds of check sizes, including growth, it's quite difficult to avoid an outcome where the growth deals are not sucking up all the attention of the leadership, because you're just risking so much more money, and you're writing a $50 million check or something, as opposed to a $1 million, $2 million check. Of course, you're going to focus more on the big check. And so then how much attention can you really be giving to the smaller ones? And I think, that creates a market opening for smaller partnerships to come in and be laser focused just on early stage.
There's another slightly more controversial perspective on this, which is that mega VCs, I think, rightfully have become the size they have, billions of dollars, right? I won't mention any names, but all the big ones that people think of, like top 5, top 10 even, that are, I think, currently have like 80% plus of the total allocation from LP dollars. They have become large because VC has institutionalized. LPs have become more comfortable with the asset class. And to our earlier point of allocators, LPs wanting something different from the stock market, I mean, that's what VC can do, right? It's uncorrelated to the stock market. It can be relatively stable during cycles, major financial cycles. So large dollars have been deployed into those large VCs, and those VCs have to deploy it. It's not even like, okay, we're risking more dollars in the big checks versus the small. From my perspective, it's they have to deploy that capital, right? They have a few $1 billion over a 5-year active deployment period. They have to do it with the given team size. What's going to get that done, right? It's going to be the bigger checks. Like they can't do hundreds of or thousands of $1-2 million checks. So yeah, that's particularly timely and interesting right now, because we are seeing a lot of founders just building more leanly with teams powered by AI, building with AI for applications, special verticals. It is very interesting. And then this brings up the topic of seed strapping and stuff, but I won't kind of keep rambling on that.
I think we're seeing a difference in strategy too, though. The evolution of these large bloated funds seems natural given the history that you've painted, Simon. The problem, though, exists in there's a big gap in the smaller check side of the industry right now. And so how is that gap going to be filled? And one of the things that we've done with our own fund is we've stayed small and committed to staying small to continue to tackle those smaller deals. And we're seeing a big shift in the industry right now. There's actually a big sort of bifurcation event seemingly coming up, in which there are either these gigantic funds that need to deploy vast amounts of capital, and they seem to be deploying them into all of the very hyped deals around AI, around humanoid robotics, because they have to Simon's point, be deploying right now. On the flip side, we have the smaller niche funds that are tackling underserved pieces of the industry, getting in at those early deals. And one of our stances is that is where the true alpha lies right now in this current cycle of venture, not necessarily going for these like giant capital deployment cycles, and rather being very selective and careful about the size of check and capital allocation. I guess there's another piece that we can bring up too, Sebastian, you talk about in your book, when the 2% is more lucrative than the 20 in some cases for these larger funds. I wonder if you could elaborate on that concept.
Sure. I mean, whether you're talking about hedge funds or private equity or venture capital, all of these asset classes, sort of, so-called alternatives, have gravitated towards some version of that 2 and 20 model, whereby you might raise whatever it is, 50 million, 100 million for a fund. You charge 2% of that as your management fee per year. And that's supposed to cover your management costs, right? Your costs of running the show. But then your remuneration is supposed to come mainly from sharing the 20% of the upside in your successful investments. And I trace this in my hedge fund book, goes way back to when the first hedge fund was set up by Alfred Winslow Jones in 1949. And he in turn attributed it to a sort of ancient seafaring captain model, where the captain of the ship would, go on an expedition, leaving Italy or Portugal or somewhere, maybe to the Americas, and would keep 20% of the profits from the voyage, and his sponsors would get 80%. But interestingly, Alfred Winslow Jones, when he did this in 1949, his model was not 2 and 20, it was 0 and 20. He didn't take a management fee. And then about 20 years later, hedge funds started to take a management fee of 1%. And then they started taking 2%. And then starting around 1980, you get private equity firms starting up, and they become really big, because when you're doing buyout, you're buying entire big companies out of the stock market, you're deploying a lot of capital. And your 2 and 20 model now, suddenly it's 2% on a very large base, right? You've got way bigger funds in private equity. And so the private equity people have always been incentivized partly just to amass a lot of assets and think about the bigger your capital base, the more your AUM, the more you're just going to earn in this 2% annual management fee. And that could be enough to make everybody in your firm, very rich and happy. And the 20% is sort of jam on top, but it's not essential. And so what I think ventures is a bit of a transition. It used to be very much focused on the 20, not the 2, because the fund sizes were small, so there was a limit to what you could get out of the 2%. But as you move into growth, the fund sizes become big, and the 2% becomes very meaningful. And so, what some managers call assetization, or the chasing of assets as opposed to performance, becomes baked into your incentive structure, that it's quite hard to resist that. And I think that does sort of, in a way, corrupt the alignment of incentives that the original 2 and 20 was supposed to deliver.
It's interesting because it's kind of like a prime example of principal agent misalignment in my mind, but it not only causes challenges for this between LP to GP, meaning profit alignment is disincentivized versus deployment is incentivized. But I also argue that it does that as well with founders, right? Because it actually incentivizes large VCs to deploy more and to almost like force certain startups to be capital intensive, because they're more free flowing with startups that are able to absorb it, whether this is due to a frothy bubble area or whether it's due to just being in a business that is inherently more capital intensive, like manufacturing, hardware, like infrastructure stuff. And what happens when startups take a lot of capital and overcapitalize? Well, founders become overly diluted. So that's kind of like an interesting point that I think the more experienced founders are starting to realize, especially second-time founders. We recently funded exited founder who had almost a $2 billion exit, and he specifically only raised $3 million at pre-seed, and took money from top tier VCs alongside us, but he just wanted to be very efficient and very lean. They're also building with AI, so that helps. But yeah,
that makes sense. I mean, there's some quote, I forget who it was exactly, but be careful. It might have been Paul Graham. Be careful of the money you take, because every single dollar will come out of your backside. I think another thing here, though, which we haven't raised, but which is sort of very relevant to this kind of scale of capital, is that the whole idea of network effects, of winner takes all effects, gave rise to this blitzscaling idea, which Reid Hoffman of Greylock and LinkedIn popularized. Mm-hmm. And the blitzscaling idea was essentially, whatever market you're going after, whether you're doing LinkedIn, Airbnb, any of these sort of two-sided marketplaces or social media companies, it's, the more users you have on the platform, the more valuable it will be to all of the members of the platform. So it's all about getting that critical mass of size before your competitors. So you've just got to blitzscale. You've got to go as fast as possible to scale up as fast as possible. And that became a sort of rationale for the venture investor to come along to the founder and say, look, I see your plan. You're planning to expand at this rate. Now you're going to triple that. And I'm going to give you 3 times more money than you wanted. And you're going to hire people, and you're going to scale up. And your hair is going to be on fire. But if you don't do that, somebody else will, and you'll lose the whole market. You've got to blitzscale. And that kind of was appropriate advice in these certain winner-takes-all network effect two-sided marketplaces. It's not appropriate advice in many other settings. And I think sometimes what happens with venture history is that something that made sense in one era kind of carries over a bit into the next one without people realizing, but there was a reason why we did blitzscaling. And now if you're doing something else, if you're doing I don't know, fusion or clean batteries or whatever. It's much less of a winner-takes-all system, and you should build carefully. And so I think so many of these things, as I said before, venture is less financial cycle dependent than it is technological wave dependent, and the technological wave, influences everything, including what is an appropriate amount of capital to stuff into the startup.
We have had Chris Ye on the podcast last year. We should have the two of you. I think it would be an interesting conversation. But yeah, I agree. Like I'm friends with Chris, the co-author of Blitzscaling and GP at Blitzscaling Ventures. And yeah, we've had conversations around this. I think certainly network effect is super important. And that's why obviously they focus on winner takes all and businesses where network effect will be very strong. And typically that is consumer. Maybe I haven't explicitly talked to him about this, but I'm curious to have the conversation. Like maybe that's less applicable in enterprise B2B sales type environments where it's not going to be winner takes all. In fact, like from our experience, the industrial space, the technical manufacturing, even engineering tools, it's usually there's at least a triopoly type of situation where there's two or three or four major players, and the space is big enough to still have excellent outcomes, especially if you're coming in super early like us at the first rounds and having good ownership. That's an interesting point.
We see a version of this sort of similar argument. If you look at, say, what's going on with Google right now, why did a traditionally software-only company decide to make hardware? Why did they go and make, watches that compete with the Apple Watch? They have a good phone now. Well, they're doing all this because they see no choice. I mean, they think that to keep their software in front of consumers and not somebody else's software, they need the hardware platforms as part of the lineup. And so I think sometimes these decisions are kind of compelled by a broader, the kind of climate of competition drives you to spending more, investing more, doing some extra kind of technology that you might not otherwise do because you feel like you can't afford not to.
Do you think that was a mistake perhaps in their part? Like could they have doubled down instead on something that was more in their wheelhouse? And this doesn't necessarily need to be specifically about Google, but in terms of the history as you've seen it, have there been cases where it's better to stay disciplined around your specialization and not get looped into these larger hype waves?
It's a great question and a tough one to be sure about because it all depends on, do you execute well? If you go into something like the metaverse and, it's a bust, obviously that was a waste of time. If you ask the question, should Meta now be spending the money they're spending on recruiting a team of great AI researchers and paying them whatever, 100 million each, incredible money. The answer is too soon to tell, right? If they can make it work, everyone will say it's a great idea. If it turns out that wasn't their wheelhouse, they can't compete with Anthropic and OpenAI and Google DeepMind and maybe Grok. People will say, well, that was dumb. That was a waste of money. They should have stuck to, building out Threads or something. So I think and sometimes what happens is that you see, it fails at first, but then it works later. So I think in the Google hardware story, their smartwatches were really terrible 3 years ago. My sense is they're quite a lot better now. So you iterate, and if you're determined, you've got enough capital behind you, you can get there. So probably that was a smart decision by them in that case, because they stuck with it for long enough to make it work. What is for sure, and you see this, by the way, with government policy all the time, is throwing money at some investment plan and then not following it through. That's the worst of all worlds, because you spent money up front, but you never give yourself a chance of succeeding.
Mm-hmm. There are so many.
True of today's semiconductor policy, for example. Biden's team put money on the table to try to kickstart more chip manufacturing in the US, I kind of doubt that this will be sustained for the decade or whatever it's going to take, across multiple administrations to really drive chip manufacturing to the sort of level where it's properly competitive with Taiwan. Unless
We
Taiwan
have a lot of thoughts around the specific problem. I would love to dive into this. Unfortunately, we are at time. But Sebastian, this has been an incredible conversation. There's so many other topics that I'm very excited to dive into, perhaps in a year's time after your next launch is out in the world, and we can have some more conversations about it. To end our conversation today, though, I'd love to step out of the power law discussion and think about your career at large. And I'd love to understand if there's someone in your career that has been the most impactful, and we can give them a little shout out here at the end of our podcast.
Well, one corny one would be to say that, my wife is rather a good journalist, and I've learned a lot from her. She edits The Economist magazine. And so, that's been an incredible, both sort of personal, but also professional, intellectual partnership. Otherwise, my editor at Penguin, I've now just completed the 5th book that I've written in partnership with him. He is fantastic.
Wow.
Scott Moyers. And what I particularly like about him is that when he's giving me advice, which is often sort of like quite big picture structuring of chapters and stuff, he just says it in a way that makes me laugh. So even if I'm mad that I have to spend another 3 weeks stressing about a chapter and redoing it, he says, early on, he told me I had to take 2 chapters, one of which was describing the rise of development economics in the 50s, and the other one was like the beginnings of the World Bank in the 1950s. And he said, you put these 2 chapters together and you sort of zig and zag into the World Bank story, into the economic story, in, out. You get narrative talk, like, a race car driver or something. And, when somebody speaks to you like that, you think, yeah, I'm going to go do that. So Scott Moyers from Penguin.
That is incredible. Cheers to Scott, and cheers to your wife, certainly.
Cheers.
For all of their.
Cheers to everyone who supports us behind the scenes.
And to you guys for your partnership, your firm, and your book.
Thank you.
Thanks so much, Sebastian.
We really appreciate your time. Go for it.
Yeah. Thanks so much, guys. And I'm going to sign off. This has been Beers with VCs with Sebastian Mallaby. See you next time. Have a great weekend.